Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of September 11th. Last week, U.S. stocks were lower on lots of questions about the Fed's interest rate policy plans going forward. We saw a lot of stronger than expected data points suggesting the Fed would need to raise rates more than the markets currently anticipate. We also saw some Fed speakers come out and discuss that they're open to pausing, in other words, not raising rates, but they remain very data dependent. So speaking of data dependency, this brings us to this week. The biggest data point that we're going to watch is the Consumer Price Index, or CPI, which comes out on Wednesday. So what I'll do today is discuss what is expected and what data is driving CPI higher in August relative to July. So let's start with expectations. CPI is expected to rise from July's 0.2% to a whopping 0.6%. If you translate this to year over year, this means going from 3.2% to 3.6%. I'll explain a little bit later why the big jump in overall CPI. Core CPI, which is more reflective of the overall inflation story because you remove volatile food and energy prices, is expected to be 0.2%, same as July. So the key question is, what is driving CPI higher in August relative to July? First, as you see here, oil prices have surged. This is the primary reason why headline CPI is expected to rise, and core CPI, again, taking out volatile food and energy prices, is flat month over month. We're watching energy prices very carefully because energy prices flow into production costs, transportation costs. Second, as you see here, the decline in used car prices has definitely slowed. This means less disinflation for CPI. Third, what I'm worried the most about, and we talked about this last week, is ISM prices paid indices. Remember, these are the first look at last month's economy, and they're showing a pickup in overall prices paid. The key point here is that these tend to lead CPI about 3 to 6 months in advance. So all of these are likely to put upward pressure on CPI, but what could help slow CPI? The answer is simply rent. As you see here, according to apartmentlist.com, asking rent for new listings fell 1.2% year over year. The impact is lagged on inflation, but slowing rent will feed their way through CPI and overall rent inflation pretty quickly. For example, we saw July CPI rents were up 8% year over year. Eventually, this asking rent will flow its way into CPI rent. So overall, the key takeaway is that according to Fed speak, the Fed feels good at these interest rate levels, but they remain very data dependent. The markets have a 92% chance that the Fed does not raise rates at their next meeting later this month, but the markets are also mixed for the remaining 2 meetings after that this year. If inflation surprises on the upside, this throws a wrench in those plans and may force the Fed to raise interest rates. Thank you for listening. For more information, please follow us on Twitter at Cetera IM, and I'll see you next week, and thank you.